Most people think you need to be rich to invest in real estate. You don't. What you actually need is a property that pays for itself. The bank doesn't need to see your W-2, they don't need to see your tax return, and it doesn't need to see what your boss pays you. It needs to see one thing. Does the rent cover the mortgage? If the answer is yes, you might already qualify for a loan that you've probably never even heard of. It's called a DSCR loan. And in this video, I'm going to break down exactly how it works, who it's built for, and just how to figure out if your next investment property qualifies. So let's get into it. DSCR stands for Debt Service Coverage Ratio. Trust me, I know, it sounds like something straight out of a finance textbook. So I'll go ahead and translate it for you. A DSCR loan is a mortgage specifically designed for an investment property. And the way it works is actually pretty simple. Rather than the lender qualifying you based off of your personal income, your pay stubs, your W-2s, your tax forms, they qualify the property. So here's how the math works. DSCR equals monthly rent divided by the total monthly payment. The payment includes principal, interest, taxes and insurance, and any association dues if there are any. So let's say a property rents for $2,500 per month, and the total mortgage payment, everything included, is $2,000 a month. You divide $2,500 by $2,000 and you get 1.25. That is your DSCR ratio. 1.25 DSCR ratio, simply put, means that the property earns $1.25 for every dollar that it owes. And that's a healthy number. Lenders definitely like that. Now you might ask, what is the minimum? While there are lenders who will go below 1 on a D, most lenders would like to see at least a 1.0 ratio. 1.0 means that the rent covers exactly the mortgage payment, a break even. Above a 1 means positive cash flow. Below 1 means that the rent does not cover the total mortgage payment. Like I said, in certain scenarios, some lenders I work with will go below 1, some will even go to 0.75, but it depends on the overall credit profile and certain other factors like reserves and the strength of the file. If you want a clean approval, 1.0 is definitely your target range. And here's exactly what I want you to notice about all of this. Not one time have I mentioned your income, not your salary, not your 1099s, not your Schedule C. The property qualifies, not you. That is the whole point of this loan. Now let's talk about exactly who can use this loan. There's about 4 groups of people who use DSCR loans, and I want you to hear it if you're one of them. Group 1, self-employed investors. If you own a business and you're doing it right, your tax returns probably look pretty terrible. Your CPA doing their job. But then you walk into the bank and you hand them those tax returns and the bank says you make $30,000 a year. But your actual cash flow is 2 or 3 times that. With a DSCR loan, none of that matters. The property qualifies on its own, and your tax returns don't even enter the conversation. If you've got 3, 4, 5 investment properties, your debt to income ratio is going to start to look pretty stretched, even if your portfolio is generating some stable, solid income. Conventional loans actually hold a cap on how many financed properties you can even own. Fannie Mae limits you to 10. DSCR loans, no such restriction. Group 3, first-time real estate investors. This one usually comes as a surprise. You don't have to be an experienced landlord to get a DSCR loan. If the property cash flows and you have a strong credit profile, you can qualify. A lot of first-time investors use DSCR because they want to keep their personal finances completely separate from their business. They don't want to intermingle the two, and this loan allows you to do just that. Group 4, short-term rental investors. Airbnb hosts, VRBO rentals, vacation rentals. This is a market I know particularly well because I work in it. I'm licensed in Wyoming, which includes Jackson Hole. And if you know that market, you know that the short-term rental income can be significant. I'm also licensed in Florida. Beach markets, tourist markets, high demand vacation rental areas. And here in Ohio, the short-term rental market has expanded into college towns, lake communities, and rural weekend getaways. DSCR loans can be structured around short-term rental income. Some lenders will use projected Airbnb revenue, and that right there will open up a lot of deals that most conventional lenders won't even touch. All right, so what does the process actually look like? So you've got a property in mind. Maybe it's a duplex in Columbus. Maybe it's a cabin just outside of Jackson Hole that you want to put on Airbnb. Or maybe it's a single family rental near a military base in Virginia Beach. Step 1, we identify the property and run the rental analysis. the lender is going to order what's called a 1007 appraisal that not only looks at the property's fair market value, but also the rent schedule. This is a form that comes back from the appraiser with an estimate of what the property would rent for at fair market value. Now for short-term rentals, depending on the lender, we may use market rent analysis or comparable STR data from platforms like AirDNA. That number, whatever comes back, becomes the income figure in your DSCR calculation. Step 2, we run the math. We take that figure, we divide it by your projected monthly payment, including taxes and insurance, and we see where the ratio lands. If you're at 1.0 or above, we're in business. Links to book a call and start an application are in the description below. Step 3, now let's look at what DSCR lenders look at on the personal side, because it's not zero. Credit score. Most lenders are going to want to see a 680 or above. Some may go as low as 640, depending on other factors in the deal. Down payment. DSCR lenders are going to see at least 20 to 25% down. This is an investment property, not a primary residence. You're definitely not getting in at 3 or 3.5%. This one's important, reserves. Lenders want to see that you have cash sitting somewhere at closing that you can tap into if for some reason the property isn't renting for a while. They typically want to see 6 to 12 months of the mortgage payment sitting in savings or investment accounts. Step 4, property type. DSCR loans work for single family rentals, small multifamilies up to 4 units, condos, townhomes, and in many cases, short-term rentals. One important rule, the property cannot be your primary residence. The loan is strictly for non-owner occupied investment properties. So here's the bottom line. If you've been sitting on the sidelines of real estate investing because you think your income is too complicated, too low on paper, or too tied up in write-offs inside your business, DSCR might be exactly what changes that. The property qualifies, not you. And if you're already an investor looking to scale, if you want to keep adding properties without grinding through personal income documentation, this is the exact tool that makes that possible. I work with investors across Ohio, Virginia, Florida, Idaho, and Wyoming. Short-term rentals, long-term rentals, single family, multifamily. If you've got a deal that you're evaluating, or if you just want to understand what your buying power looks like using a DSCR loan, I want to run the numbers with you. The links to get started are in the video description below. You can book a call directly on my calendar, just a real, authentic conversation about your deal. You can also start your application right there. It takes about 5 minutes. And if you want a quick answer first, DM me the word invest on Instagram, and I'll reach back out quickly. If this video helped you understand DSCR loans a little bit better, drop a comment below with the market you're investing in. I genuinely love to see where you're looking. And if you're not subscribed yet, hit that button. I put out content on investment loans, VA loans, first responder mortgages, and what's actually happening in the market right now. No fluff, just real information. I'll see you in the next one.